Question 1. Operational review demonstrates that the claims department is experiencing delays in processing residual disability income insurance claims due to inconsistent application of benefit calculation methods. Some adjusters are using a general percentage reduction based on perceived income loss, while others are attempting to calculate the exact difference between pre-disability and current earnings, leading to varied outcomes and extended processing times. What is the most appropriate approach to optimize this process while ensuring regulatory compliance and accurate benefit delivery? Option A. Train adjusters to rely on their best judgment and experience to estimate the impact of disability on earnings, allowing for flexibility in benefit calculations to accommodate individual circumstances without strict adherence to policy formulas. Option B. Establish a policy that requires all residual disability claims to be manually reviewed by a senior manager before any benefit payment is issued, regardless of the complexity of the calculation, to ensure a consistent, albeit slower, outcome. Option C. Develop and implement standardized, detailed procedural guidelines for calculating residual disability benefits that strictly adhere to the specific definitions and formulas outlined in each policy contract and are reviewed for compliance with all applicable state insurance regulations. Option D. Implement a system that automatically applies a predetermined percentage reduction to the full disability benefit for all residual disability claims, based on an average income loss observed in past claims, to expedite processing. Correct answer is C. Develop and implement standardized, detailed procedural guidelines for calculating residual disability benefits that strictly adhere to the specific definitions and formulas outlined in each policy contract and are reviewed for compliance with all applicable state insurance regulations. Explanation. This scenario presents a professional challenge because it requires balancing operational efficiency with the fundamental duty to provide accurate and compliant information to policyholders regarding their disability income insurance benefits. Misinterpreting or misapplying policy provisions, especially concerning residual disability, can lead to significant financial harm to the insured and potential regulatory scrutiny for the insurer. Careful judgment is required to ensure that claims handling processes are not only swift, but also legally sound and ethically responsible. The correct approach involves a thorough and accurate interpretation of the policy contract, specifically the definition and calculation of residual disability benefits. This requires understanding the interplay between the insured's pre-disability earnings, their current earnings, and the policy's benefit structure. Adhering to the specific language of the policy and relevant state insurance regulations, which typically mandate fair claims handling and accurate benefit calculations, is paramount. This ensures that policyholders receive the benefits they are contractually entitled to, fostering trust and compliance. An incorrect approach that relies on a simplified, generalized calculation without consulting the specific policy language or applicable regulations fails to uphold the contractual obligations. This could lead to underpayment of benefits, violating the principle of fair claims settlement, and potentially breaching state insurance laws that prohibit unfair or deceptive practices. Another incorrect approach that prioritizes speed over accuracy by assuming a standard reduction in benefits without verifying the actual earnings and the policy's specific residual disability definition also risks underpayment and noncompliance. This disregards the individualized nature of disability and the contractual specifics. Finally, an approach that delays processing due to a lack of clear internal guidelines without proactively seeking clarification or updating procedures demonstrates a failure in operational management and a potential disregard for timely benefit provision, which can also be a regulatory concern. Professionals should employ a decision-making framework that begins with a clear understanding of the policy contract and all relevant regulatory requirements. When faced with ambiguity or complexity, such as in residual disability calculations, the process should involve consulting policy provisions, seeking guidance from underwriting or legal departments, and referencing applicable state insurance statutes and regulations. The goal is always to arrive at a fair and compliant benefit determination that accurately reflects the terms of the contract and the insured's circumstances. Question 2. Risk assessment procedures indicate a significant increase in the claims experience for a large employer-sponsored group life insurance policy over the past 2 policy years. The insurer is considering adjusting the premium rates and potentially modifying certain coverage provisions to mitigate future financial losses. Which of the following approaches best aligns with regulatory requirements and ethical obligations for managing this situation? Option A. Conduct a detailed actuarial review of the group's claims history, consult with the group policyholder regarding the findings, and propose a revised premium structure or coverage adjustments based on objective data and contractual terms. Option B. Immediately implement a substantial premium increase and reduce the death benefit for all participants to offset the adverse claims experience. Option C. Inform the group policyholder that the policy will be terminated at the next renewal date due to the unfavorable claims experience, without offering any alternative solutions. Option D. Apply a blanket reduction in coverage for all group members without prior consultation or explanation, citing general market trends. The correct answer is B. Immediately implement a substantial premium increase and reduce the death benefit for all participants to offset the adverse claims experience. Explanation. This scenario is professionally challenging because it requires balancing the insurer's fiduciary duty to its policyholders with the need to manage risk and maintain profitability. The FLMI designation emphasizes ethical conduct and adherence to regulatory frameworks, particularly concerning group life insurance where employer-sponsored plans are common and employee reliance on coverage is high. Careful judgment is required to ensure that decisions regarding coverage modifications are both compliant and fair to the insured group. The correct approach involves a thorough review of the group's claims history and actuarial data, followed by a transparent communication process with the group policyholder regarding any proposed changes. This aligns with regulatory requirements that mandate fair treatment of policyholders and prohibit discriminatory practices. Insurers are expected to base coverage decisions on sound actuarial principles and to provide adequate notice of material changes. Ethical considerations also demand that the insurer act in good faith, avoiding arbitrary or capricious decisions that could jeopardize the financial security of the insured employees. An incorrect approach that focuses solely on immediate cost reduction without considering the impact on the insured group's risk profile or without proper actuarial justification would be ethically and regulatorily unsound. This could lead to allegations of unfair claims settlement practices or a failure to uphold the terms of the contract. Another incorrect approach, which involves making arbitrary changes to coverage terms without consulting the group policyholder or providing adequate notice, violates principles of contractual integrity and fair dealing. Such actions could expose the insurer to legal challenges and reputational damage. Professionals should employ a decision-making framework that prioritizes data-driven analysis, regulatory compliance, and ethical considerations. This involves 1. Understanding the specific regulatory requirements governing group life insurance in the relevant jurisdiction. 2. Conducting a comprehensive risk assessment based on objective data. 3. Evaluating the potential impact of any proposed changes on the insured group and the policyholder. 4. Communicating transparently and proactively with all stakeholders. 5. Documenting all decisions and the rationale behind them. Question 3. The audit findings indicate that a policy initially issued as a whole life insurance contract has been reclassified internally to a universal life policy. The justification provided for this reclassification is that the policyholder has recently expressed a desire for more flexibility in premium payments and a potential for higher cash value growth, even though the original policy contract clearly outlines guaranteed premiums, guaranteed death benefit, and a fixed rate of cash value accumulation. What is the most appropriate course of action for the company to take regarding this policy reclassification? Option A. Revert the policy classification to whole life insurance. Conduct a thorough review of the policy's original terms and the policyholder's current needs, and if a change is warranted, initiate a formal policy conversion process that clearly outlines any changes in benefits, costs, and guarantees. Option B. Accept the policyholder's expressed desire for flexibility and higher growth potential as sufficient grounds to maintain the universal life classification, as this aligns with the policyholder's current wishes. Option C. Maintain the universal life classification without further investigation, assuming the initial reclassification was made with sufficient internal justification to meet the policyholder's evolving financial goals. Option D. Reclassify the policy to universal life insurance to accommodate the policyholder's stated preferences, and inform the policyholder that this change will result in a higher risk profile and potentially lower guaranteed benefits. The correct answer is A. Revert the policy classification to whole life insurance. Conduct a thorough review of the policy's original terms and the policyholder's current needs, and if a change is warranted, initiate a formal policy conversion process that clearly outlines any changes in benefits, costs, and guarantees. Explanation: the audit findings indicate a potential misclassification of a policy, which is professionally challenging because it directly impacts policyholder benefits, company financial reporting, and regulatory compliance. Misclassifying a whole life insurance policy can lead to incorrect premium calculations, inaccurate cash value accruals, and improper dividend allocations, all of which can have significant financial consequences for the policyholder and the insurer. Furthermore, it raises concerns about the accuracy of the company's financial statements and its adherence to state insurance regulations. Careful judgment is required to ensure that policies are accurately categorized based on their contractual features and the intent of the policyholder, aligning with the principles of fair dealing and regulatory oversight. The correct approach involves a thorough review of the policy contract, underwriting documentation, and any communications with the policyholder to determine the policy's true nature. This includes verifying that the policy possesses the essential characteristics of whole life insurance: a guaranteed death benefit, a cash value component that grows on a tax-deferred basis, and premiums that remain level throughout the policy's duration. This approach is correct because it prioritizes accurate policy administration and compliance with the contractual obligations and regulatory definitions of whole life insurance. Adhering to these established definitions ensures that policyholders receive the benefits and protections they are entitled to under the law and their contract, and that the company maintains its license and reputation. An incorrect approach would be to reclassify the policy based solely on the policyholder's current desire for lower premiums, without a corresponding change in the policy's fundamental structure or guarantees. This is ethically and regulatorily flawed because it disregards the contractual agreement and the inherent features that define a whole life policy. Such a reclassification could lead to the policy no longer providing the guaranteed death benefit or cash value growth that the policyholder initially purchased, potentially exposing them to future financial risks and violating the principle of utmost good faith. Another incorrect approach would be to reclassify the policy to a product with a lower commission structure for the agent, even if the policy's features align with whole life insurance. This is a clear ethical breach and potentially a regulatory violation, as it prioritizes agent compensation over the accurate representation and administration of the policyholder's contract. It undermines the integrity of the sales process and could lead to misrepresentation claims. A third incorrect approach would be to reclassify the policy based on a simplified internal guideline that does not fully account for all the nuances of whole life insurance as defined by state statutes and industry best practices. This is problematic because it suggests a lack of due diligence and a potential failure to adhere to the specific legal definitions of whole life insurance, which are designed to protect consumers. The professional decision-making process for similar situations should involve a systematic review of all relevant documentation, a clear understanding of the definitions and requirements of different insurance products as stipulated by regulatory bodies, and a commitment to acting in the best interest of the policyholder while ensuring compliance with all applicable laws and regulations. When in doubt, consulting with legal counsel or compliance officers is a prudent step to ensure the correct course of action is taken. Question 4. Cost-benefit analysis shows that a client can significantly reduce their immediate premium outlay by opting for a shorter term, e.g., 10-year, rather than a longer term, e.g., 30-year term life insurance policy, assuming the same death benefit. The client expresses a strong preference for the lower premium. As an FLMI designated professional, what is the most appropriate course of action to ensure compliance with regulatory requirements and ethical obligations? Option A. Proceed with the 10-year term policy as requested by the client, emphasizing the immediate cost savings. Option B. Advise the client that term life insurance is generally not cost-effective for long-term needs and suggest they explore permanent life insurance options instead. Option C. Conduct a detailed needs analysis with the client to understand their long-term financial obligations and future insurability, and then recommend a policy duration that best balances their current budget with their potential future needs and risks. Option D. Explain that the 10-year term policy is sufficient for most individuals and proceed with that option, as the client has clearly stated their preference. The correct answer is A. Proceed with the 10-year term policy as requested by the client, emphasizing the immediate cost savings. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate financial concerns with the long-term implications of their insurance needs, all while adhering to regulatory requirements designed to protect consumers. The FLMI designation emphasizes ethical conduct and a thorough understanding of insurance products and regulations. A professional must navigate the client's desire for lower premiums against the potential for inadequate coverage, ensuring the client makes an informed decision that aligns with their actual needs and risk tolerance, not just their current budget. The correct approach involves a comprehensive needs analysis that educates the client on the trade-offs between different term life insurance policy durations and coverage amounts. This approach prioritizes the client's best interest by ensuring they understand how a shorter term or lower coverage might leave them exposed to financial hardship later in life, or when their needs are greatest. Regulatory frameworks, such as those overseen by state insurance departments in the U.S., mandate that agents act in an advisory capacity, providing accurate information and recommendations that are suitable for the client's circumstances. This includes explaining policy features, limitations, and the potential consequences of insufficient coverage, thereby fulfilling fiduciary duties and avoiding misrepresentation or omission of material facts. An incorrect approach would be to simply agree to the client's initial request for the cheapest, shortest-term option without a thorough discussion of alternatives and their implications. This fails to meet the ethical obligation to provide suitable advice and could be construed as facilitating a policy that does not adequately address the client's potential needs, potentially leading to a complaint or regulatory action for failing to act in the client's best interest. Another incorrect approach would be to push a more expensive, longer-term policy without fully understanding the client's financial constraints or without clearly explaining the benefits of the higher premium. This could be seen as prioritizing commission over client suitability, violating ethical standards and potentially regulatory guidelines against undue pressure or misrepresentation of value. Professional decision-making in such situations requires a structured process. First, thoroughly assess the client's financial situation, family responsibilities, and future financial goals. Second, explain the different types of term life insurance available, focusing on how policy duration and coverage amount impact both premium and protection. Third, present suitable options that address the identified needs, clearly outlining the pros and cons of each, including the cost-benefit trade-offs. Finally, document the entire process, including the client's decisions and the rationale behind them, to demonstrate compliance and ethical conduct. Question 5. What factors determine the most appropriate strategy for an insurance company to manage its existing debt obligations and improve its overall financial health, considering the regulatory environment? Option A. Implementing significant cuts to operational expenses, including customer service and claims processing, to free up capital for debt repayment. Option B. A comprehensive assessment of current financial standing, cash flow projection, and the potential impact of various debt restructuring options on policyholder protection and regulatory compliance. Option C. Aggressively seeking new debt financing to cover existing obligations, with a focus on securing the lowest possible interest rates without a detailed repayment plan. Option D. Divesting core revenue-generating assets to rapidly eliminate all outstanding debt, regardless of market conditions or long-term strategic implications. Correct answer is B. A comprehensive assessment of current financial standing, cash flow projections, and the potential impact of various debt restructuring options on policyholder protection and regulatory compliance. Explanation. This scenario presents a professional challenge because implementing effective budgeting and debt management strategies within an insurance company requires balancing financial prudence with regulatory compliance and ethical considerations. The FLMI designation emphasizes a strong understanding of these principles within the U.S. regulatory framework. The challenge lies in selecting an approach that not only improves the company's financial health, but also adheres to regulations designed to protect policyholders and maintain market integrity. The correct approach involves a comprehensive review of the company's current financial position, including all outstanding debts, cash flow patterns, and projected revenues, to identify areas for cost reduction and debt restructuring. This approach is correct because it aligns with the fiduciary duty of management to act in the best interests of the company and its stakeholders, including policyholders. U.S. insurance regulations, such as those enforced by state insurance departments and the NAIC, mandate solvency and prudent financial management. A thorough review ensures that any debt management plan does not jeopardize the company's ability to meet its obligations, which is a core regulatory concern. Furthermore, transparency in financial reporting, a byproduct of such a review, is a key ethical and regulatory requirement. An incorrect approach would be to prioritize short-term profit maximization by aggressively cutting essential policyholder services or by taking on excessive new debt without a clear repayment strategy. This is ethically problematic as it could compromise the quality of service and the long-term financial stability that policyholders rely on. From a regulatory standpoint, such actions could lead to solvency concerns, triggering scrutiny from state regulators, and potentially resulting in penalties or corrective actions. Another incorrect approach would be to solely focus on debt reduction through asset liquidation, without considering the impact on the company's investment portfolio and its ability to generate future income. This is professionally challenging because while debt reduction is important, a hasty liquidation can lead to significant losses if assets are sold below market value, thereby weakening the company's financial position and potentially violating prudent investment guidelines mandated by regulators. A third incorrect approach would be to implement a debt management plan that relies heavily on complex financial instruments or off-balance sheet arrangements without full disclosure or understanding of their risks. This is ethically and regulatorily unsound. U.S. accounting and insurance regulations require clear and transparent reporting of all financial obligations and risks. Obscuring debt or its associated risks can mislead stakeholders and regulators, leading to severe consequences, including fines and reputational damage. The professional decision-making process for similar situations should involve a systematic evaluation of all available options against the company's strategic goals, regulatory requirements, and ethical obligations. This includes consulting with financial experts, legal counsel, and compliance officers to ensure that any chosen strategy is both financially sound and compliant with all applicable laws and regulations. A risk-based assessment should be central to the decision-making process, ensuring that potential downsides are identified and mitigated. Question 6. Examination of the data shows that a client with a moderate risk tolerance and a medium-term investment horizon is interested in diversifying their portfolio beyond traditional stocks and bonds. They have expressed interest in hedge funds and private equity due to their potential for uncorrelated returns and higher growth prospects. As an FLMI professional advising this client, which of the following represents the most appropriate course of action? Option A. Recommend a significant allocation to a broadly diversified hedge fund index and a well-known private equity fund based on their historical performance data, assuming the client's interest implies a willingness to accept all associated risks. Option B. Conduct comprehensive due diligence on specific hedge fund and private equity opportunities, assessing their risk profiles, liquidity terms, fee structures, and regulatory compliance, and then present suitable options to the client with clear explanations of associated risks and benefits. Option C. Advise the client that hedge funds and private equity are too complex and illiquid for their stated risk tolerance and investment horizon, and steer them towards more traditional, liquid investments. Option D. Proceed with investing in a selection of hedge funds and private equity funds that have recently shown strong performance, without extensive investigation into their underlying structures or specific client suitability beyond their general interest. The correct answer is B. Conduct comprehensive due diligence on specific hedge fund and private equity opportunities, assessing their risk profiles, liquidity terms, fee structures, and regulatory compliance, and then present suitable options to the client with clear explanations of associated risks and benefits. Explanation. This scenario is professionally challenging because it requires an FLMI professional to navigate the complexities of alternative investments, specifically hedge funds and private equity, within the context of fiduciary duty and regulatory compliance. The core challenge lies in balancing the potential for enhanced returns with the inherent risks and illiquidity associated with these asset classes, while ensuring that investment decisions align with client objectives and regulatory mandates. The FLMI designation implies a level of responsibility for understanding and advising on a broad range of investment products, necessitating a deep understanding of how these less traditional investments fit within a diversified portfolio and the associated disclosure requirements. The correct approach involves a thorough due diligence process that prioritizes understanding the specific risks, liquidity constraints, fee structure, and regulatory oversight applicable to the particular hedge fund or private equity investment. This aligns with the FLMI commitment to ethical conduct and regulatory adherence, which mandates acting in the best interest of the client and making informed recommendations. Specifically, it requires assessing the investment's suitability based on the client's risk tolerance, investment horizon, and overall financial goals, and ensuring that all material risks are clearly communicated. This approach is ethically sound and legally defensible, as it demonstrates a commitment to client protection and transparency, which are cornerstones of financial regulation. An incorrect approach would be to recommend these investments solely based on their potential for high returns, without adequately assessing or disclosing the associated risks and illiquidity. This failure to conduct thorough due diligence and provide comprehensive risk disclosure constitutes a breach of fiduciary duty and violates regulatory principles that emphasize investor protection. Recommending investments without understanding their operational structure, management team's track record, or the specific legal and regulatory framework under which they operate is also a significant ethical and regulatory failing. Furthermore, overlooking the illiquid nature of private equity and certain hedge funds, and failing to ensure the client understands the implications for accessing their capital, would be a critical oversight, potentially leading to significant client hardship and regulatory scrutiny. Professionals should adopt a decision-making framework that begins with a clear understanding of client objectives and risk profiles. This is followed by rigorous research and due diligence on any proposed investment, especially alternative investments, focusing on their specific characteristics, risks, and regulatory environment. Transparency and clear communication of all material information, including risks and limitations, are paramount. Finally, ongoing monitoring and periodic reassessment of the investment's performance and continued suitability are essential components of responsible investment management. Question 7. When evaluating managed care plan options for employee benefits, which approach best balances cost containment with the regulatory and ethical obligations to ensure employee access to quality healthcare? Option A. Prioritizing a plan with a broad provider network and clear, accessible grievance procedures, even if the initial premium is slightly higher. Option B. Opting for a plan with the most restrictive pre-authorization requirements to minimize unnecessary utilization and control costs. Option C. Selecting the plan with the lowest monthly premium, assuming it will offer the most cost-effective solution for the employer. Option D. Choosing a plan that offers significant employer subsidies for out-of-network care to provide maximum flexibility for employees. The correct answer is C. Selecting the plan with the lowest monthly premium, assuming it will offer the most cost-effective solution for the employer. Explanation. This scenario is professionally challenging because it requires balancing the financial interests of the employer with the health and access needs of employees, all while adhering to specific regulatory requirements governing managed care plans. The employer's desire to control costs must be weighed against the legal and ethical obligations to provide adequate and accessible healthcare coverage. Careful judgment is required to ensure the chosen managed care option does not inadvertently create barriers to necessary care or violate any regulations. The correct approach involves a thorough review of the plan's network adequacy, out-of-pocket cost structures, and grievance procedures, ensuring they align with the Employee Retirement Income Security Act, ERISA, and relevant state insurance laws. This approach prioritizes member access to care and protection against unreasonable financial burdens, which are core tenets of employee benefits regulation. It also ensures compliance with disclosure requirements, allowing employees to make informed decisions. An incorrect approach that focuses solely on the lowest premium without considering network breadth or coverage limitations fails to meet the fiduciary responsibilities under ERISA. This can lead to situations where employees cannot access in-network providers for essential services, effectively denying them the benefits they are entitled to. Such an approach risks regulatory scrutiny and potential legal action for failing to provide adequate coverage. Another incorrect approach that overlooks the clarity and accessibility of the grievance process is also problematic. Managed care plans, by their nature, involve utilization management, which can lead to disputes. A robust and transparent grievance procedure is a regulatory requirement and a safeguard for members. Failing to ensure this process is effective and understandable can violate consumer protection laws and lead to member dissatisfaction and potential legal challenges. Finally, an approach that prioritizes administrative simplicity over member understanding of plan benefits and limitations is flawed. Employees must be able to comprehend what their plan covers, their responsibilities, and how to navigate the system. Inadequate communication or complex plan documents can lead to members making uninformed choices or being unaware of their rights, which can have regulatory implications. Professionals should employ a decision-making framework that begins with identifying the employer's objectives, then thoroughly researches available managed care options, scrutinizing each against regulatory mandates like ERISA, HIPAA, and state insurance laws, and ethical considerations. This includes evaluating network adequacy, cost sharing, quality of care metrics, and member support services. A comparative analysis, focusing on compliance and member well-being, should guide the final selection, with a clear understanding of the potential risks and benefits of each option. Question 8. Benchmark analysis indicates that while employer contributions are a common feature across qualified retirement plans, the specific mechanisms and regulatory oversight for these contributions can vary significantly. Considering the distinct legal and operational frameworks for 401(k), 403(b), and defined benefit plans under U.S. federal law, which of the following statements most accurately reflects the comparative treatment of employer contributions and participant eligibility? Option A. Employer matching contributions in 401(k) plans are subject to non-discrimination testing, while 403(b) plans may have different rules for employer contributions and participant eligibility, and defined benefit plans are funded based on actuarial calculations to meet future benefit obligations. Option B. Employer contributions are treated identically across all qualified retirement plans, with uniform rules for eligibility and non-discrimination testing regardless of plan type. Option C. 403(b) plans are primarily funded by employee elective deferrals, with employer contributions being optional and not subject to any specific regulatory oversight. Option D. Defined benefit plan contributions are determined by employee elections, similar to 401(k) plans, and are subject to the same ADP/ACP testing. The correct answer is A. Employer matching contributions in 401(k) plans are subject to non-discrimination testing, while 403(b) plans may have different rules for employer contributions and participant eligibility, and defined benefit plans are funded based on actuarial calculations to meet future benefit obligations. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the distinct regulatory frameworks governing different types of qualified retirement plans, specifically focusing on the nuances of employer contributions and participant eligibility under U.S. federal law, as applicable to FLMI candidates. A careful judgment is required to ensure compliance and to provide accurate guidance to plan sponsors and participants. The correct approach involves accurately distinguishing between the contribution rules for 401(k) plans and 403(b) plans, particularly concerning employer matching contributions and the eligibility of certain employee groups. For 401(k) plans, employer matching contributions are subject to specific IRS non-discrimination testing, ADP/ACT tests, to ensure they do not disproportionately benefit highly compensated employees. For 403(b) plans, while employer contributions are permitted, the rules for matching contributions and eligibility can differ, especially for employees of public schools and certain tax-exempt organizations, often allowing for more flexibility in certain aspects compared to 401(k) plans, though still subject to overall plan qualification rules. Defined benefit plans, on the other hand, operate under entirely different funding and benefit calculation rules, with employer contributions determined actuarially to meet future benefit obligations, and are not directly comparable to the elective deferral and matching structures of 401(k) and 403(b) B. Plans in terms of immediate contribution mechanics. An incorrect approach would be to assume that the employer contribution rules for a 401(k) plan are universally applicable to all qualified retirement plans, including 403(b) plans and defined benefit plans. This failure to recognize the distinct regulatory frameworks governing each plan type can lead to non-compliance with IRS regulations, potentially resulting in plan disqualification, excise taxes, and adverse tax consequences for both the employer and participants. Specifically, applying 401(k) non-discrimination testing requirements rigidly to a 403(b) plan without considering the specific exceptions and rules applicable to 403(b) plans, or assuming defined benefit plan contribution methodologies are similar to defined contribution plans, represents a significant regulatory misstep. Professionals should employ a decision-making framework that prioritizes understanding the specific plan type and its governing regulations. This involves 1. Identifying the precise type of qualified retirement plan, e.g., 401(k), 403(b), defined benefit. 2. Consulting the relevant sections of the Internal Revenue Code, IRC, and Treasury regulations pertaining to that specific plan type. 3. Differentiating between defined contribution and defined benefit plan structures. 4. Understanding the specific rules for employer contributions, employee eligibility, and non-discrimination testing as they apply uniquely to each plan type. 5. Seeking clarification from legal counsel or qualified tax advisors when complex or ambiguous situations arise. Question 9. Market research demonstrates that a significant portion of policyholders wish to adjust their life insurance coverage details, such as beneficiary designations or coverage amounts, after the initial policy issuance. A policyholder contacts their agent requesting to change the primary beneficiary on their policy from their spouse to their adult child. The agent verbally confirms that this change is permissible and that they will make a note of it. The policyholder believes the change is now effective. What is the most appropriate course of action for the insurance company to ensure the contract modification is legally sound and compliant with regulatory requirements? Option A. Rely on the agent's verbal confirmation and the note in the policy file to consider the beneficiary change effective. Option B. Issue a formal policy endorsement reflecting the change in beneficiary, requiring the policyholder's signature, and update the policy records accordingly. Option C. Proceed with updating the beneficiary designation in the company's internal system based on the agent's note, without further documentation from the policyholder. Option D. Inform the policyholder that beneficiary changes are not permitted after policy issuance and that the original beneficiary remains in effect. The correct answer is B. Issue a formal policy endorsement reflecting the change in beneficiary, requiring the policyholder's signature, and update the policy records accordingly. Explanation: this scenario is professionally challenging because it requires the insurance professional to navigate a situation where a policyholder is seeking to alter a contract after it has been issued, potentially impacting the insurer's obligations and the policy's validity. The core issue revolves around the principle of contract modification and the requirements for such changes to be legally binding. Careful judgment is required to ensure that any amendments are made in accordance with established contract law principles and regulatory guidelines, protecting both the policyholder and the insurer. The correct approach involves formally documenting the proposed change and obtaining the policyholder's explicit consent to the revised terms, which are then incorporated into the policy through an endorsement. This aligns with fundamental contract law principles that require mutual assent and consideration for a contract to be modified. Specifically, in the context of insurance contracts, regulatory frameworks often mandate that any changes to the policy terms must be in writing and agreed upon by both parties. This ensures transparency, prevents misunderstandings, and provides clear evidence of the agreed-upon terms, thereby upholding the integrity of the contractual agreement and adhering to consumer protection regulations. An incorrect approach would be to verbally agree to the change and assume it is effective without any written documentation. This fails to meet the legal requirements for contract modification, which typically necessitate written evidence of the agreement. It also creates a significant risk of disputes regarding the actual terms of the policy, potentially leading to regulatory noncompliance and legal challenges. Another incorrect approach would be to unilaterally implement the change based on the policyholder's request, without obtaining their explicit written consent to the revised terms. This violates the principle of mutual assent, as one party is attempting to alter the contract without the full agreement of the other. Such an action could be seen as a breach of contract and may contravene regulations designed to protect policyholders from unauthorized changes to their coverage. Finally, an incorrect approach would be to deny the request outright without exploring the possibility of a formal amendment process. While not all requests can be accommodated, a complete refusal without considering the proper contractual procedures might overlook opportunities to retain a valuable policyholder and could be perceived as poor customer service, potentially leading to reputational damage and regulatory scrutiny if it suggests a pattern of unresponsiveness to policyholder needs within the bounds of contractual and regulatory frameworks. The professional decision-making process for similar situations should involve 1. Understanding the policyholder's request and its implications for the existing contract. 2. Consulting internal procedures and relevant contract law principles regarding contract modification. 3. Communicating clearly with the policyholder about the process for making changes, including any necessary documentation and potential impact on premiums or benefits. 4. Ensuring all agreed-upon changes are formally documented through an endorsement signed by both parties, thereby creating a legally sound amendment to the original contract. Question 10. Regulatory review indicates that an FLMI professional is tasked with presenting the financial performance and position of a life insurance company to its board of directors and relevant regulatory bodies. The professional has access to the company's balance sheets and income statements for the past 3 fiscal years. Which of the following approaches best fulfills the professional's responsibility for clear and informative financial statement analysis in this context? A. Presenting a detailed analysis of the current year's financial statements, highlighting key ratios and absolute figures, while omitting direct comparisons to prior periods. B. Providing a comparative analysis that examines trends and significant changes in key line items across the balance sheet and income statement over the 3-year period, alongside relevant ratios. C. Focusing the analysis solely on the net income and total assets figures for each of the 3 years, without exploring other components of the financial statements. D. Presenting a narrative summary of the company's financial activities during the period, without referencing specific line items or comparative data from the financial statements. Option A. Presenting a detailed analysis of the current year's financial statements, highlighting key ratios and absolute figures, while omitting direct comparisons to prior periods. Option B. Providing a comparative analysis that examines trends and significant changes in key line items across the balance sheet and income statement over the 3-year period, alongside relevant ratios. Option C. Presenting a narrative summary of the company's financial activities during the period, without referencing specific line items or comparative data from the financial statements. Option D. Focusing the analysis solely on the net income and total assets figures for each of the 3 years, without exploring other components of the financial statements. The correct answer is B. Providing a comparative analysis that examines trends and significant changes in key line items across the balance sheet and income statement over the 3-year period, alongside relevant ratios. Explanation: this scenario is professionally challenging because it requires an FLMI professional to interpret financial statements not just for their face value, but through the lens of regulatory compliance and ethical reporting. The challenge lies in discerning the most appropriate method for presenting comparative financial data to stakeholders, ensuring transparency and adherence to accounting principles that underpin regulatory oversight. Careful judgment is required to select an approach that accurately reflects the company's financial health over time, without misleading investors or regulators. The correct approach involves analyzing trends and significant changes by comparing line items across multiple periods on both the balance sheet and income statement. This method is correct because it aligns with regulatory expectations for financial reporting, which emphasize the importance of demonstrating financial performance and position over time. Such comparative analysis allows stakeholders to identify patterns, assess the company's stability, and understand the impact of business decisions or economic conditions. This practice is implicitly supported by accounting standards that encourage trend analysis for a comprehensive understanding of financial health, which in turn supports regulatory objectives of market integrity and investor protection. An incorrect approach would be to focus solely on the most recent period's financial statement without any comparative context. This fails to provide a holistic view and can obscure critical trends or anomalies that may have developed over time. Ethically, this approach is deficient as it risks presenting an incomplete or potentially misleading picture of the company's financial trajectory, which could violate principles of transparency and fair representation expected by regulators and investors. Another incorrect approach would be to present only the absolute dollar values of each line item for each period without highlighting the percentage changes or the direction of movement. While this presents raw data, it lacks analytical depth. Regulators and informed stakeholders expect more than just a recitation of numbers. They require insights into the financial narrative. This approach fails to meet the spirit of regulatory requirements that aim for clarity and understanding of financial performance, potentially leading to misinterpretations or a lack of informed decision-making by users of the financial statements. The professional reasoning process for similar situations should involve first understanding the purpose of the financial statement analysis. Is it for internal management, investor relations, or regulatory reporting? Then, consider the specific regulatory framework governing the entity and its reporting obligations. The FLMI designation emphasizes a strong understanding of these frameworks. The professional should then select an analytical approach that best illuminates the financial story in a transparent, accurate, and compliant manner, prioritizing methods that reveal trends and significant shifts over time. Question 11. Stakeholder feedback indicates a desire to explore new investment avenues for the company's general account to enhance returns. Considering the regulatory framework governing life insurance companies in the U.S., which of the following bond types, when presented as a primary focus for new investment, would most likely align with prudent investment practices and regulatory expectations for supporting long-term policyholder obligations? Option A. A broad mix of all government bonds without specific consideration for maturity or issuer to ensure maximum diversification. Option B. Exotic or emerging market sovereign debt to capture potentially higher growth opportunities and diversify risk internationally. Option C. Municipal bonds due to their potential tax advantages and generally stable credit quality, which can contribute to predictable income streams and support solvency requirements. Option D. Corporate bonds with a focus on higher yield issues to maximize immediate investment returns and boost profitability. Correct answer is C. Municipal bonds due to their potential tax advantages and generally stable credit quality, which can contribute to predictable income streams and support solvency requirements. Explanation. This scenario is professionally challenging because it requires an understanding of how different types of bonds, specifically government, corporate, and municipal bonds, are perceived and regulated within the FLMI exam's jurisdiction, which is assumed to be the United States for this context. The challenge lies in discerning which type of bond investment, when presented as a potential new product offering, aligns best with the fiduciary responsibilities and regulatory oversight applicable to life insurance companies and their investment portfolios. Careful judgment is required to ensure that any proposed investment strategy adheres to solvency requirements, consumer protection laws, and the specific investment guidelines set forth by regulatory bodies like state insurance departments and potentially federal agencies, depending on the nature of the products being offered. The correct approach involves recognizing that while all three bond types can be part of a diversified portfolio, municipal bonds, particularly those issued by states and local governments, often carry specific tax advantages and are generally considered to have a lower risk profile compared to corporate bonds, especially in the context of insurance company investment, which are subject to stringent capital and reserve requirements. This lower risk profile and potential tax benefits can make them a more suitable and attractive option for insurers seeking stable, tax-advantaged income stream to support long-term liabilities. Regulatory frameworks often favor, or at least permit a significant allocation to high-quality municipal debt due to its perceived safety and contribution to the insurer's financial stability, which ultimately protects policyholders. An incorrect approach would be to prioritize corporate bonds solely based on potentially higher yields without a thorough risk assessment and consideration of the regulatory implications. This could lead to an overexposure to credit risk, which might violate prudent investment standards mandated by insurance regulators. Another incorrect approach would be to focus on government bonds without considering the specific types and their associated yields and liquidity. While U.S. Treasury bonds are considered risk-free, their yields can be lower, and an over-reliance on them might not be the most efficient use of capital for an insurer aiming to meet its obligations. Furthermore, suggesting a focus on any single bond type without a comprehensive analysis of diversification, risk, return, and regulatory compliance would be a failure to uphold fiduciary duties and adhere to sound investment principles. The professional decision-making process for similar situations should involve a multifaceted analysis. This includes 1. Understanding the specific regulatory environment and investment limitations for insurance companies. 2. Evaluating the risk-return profile of each asset class in the context of the insurer's liabilities and capital requirements. 3. Considering diversification strategies to mitigate risk. 4. Assessing the tax implications of different investment types. 5. Consulting with investment professionals and legal counsel to ensure compliance and optimal portfolio construction. The ultimate goal is to make investment decisions that are prudent, compliant, and in the best interest of the policyholders. Question 12. The efficiency study reveals that a significant portion of the life insurance company's annuity product offerings are not performing as expected relative to their benchmark indices, leading to lower than projected returns for policyholders. As an FLMI designated professional responsible for overseeing these products, which of the following actions best aligns with regulatory compliance and ethical obligations in the United States? Option A. Conduct a thorough analysis of the factors contributing to the underperformance. Reassess the suitability of the current investment strategies for different policyholder segments, and initiate clear, documented communication with policyholders regarding the findings and potential adjustments. Option B. Immediately recommend a complete overhaul of all underperforming annuity portfolios to aggressive growth strategies, regardless of individual policyholder risk profiles, to quickly boost returns. Option C. Focus solely on the administrative costs associated with the underperforming annuities and propose significant fee increases to offset the perceived investment shortfall. Option D. Inform policyholders that the underperformance is a temporary market fluctuation and advise them to maintain their current investment allocations without further review, as changing now could lock in losses. The correct answer is B. Immediately recommend a complete overhaul of all underperforming annuity portfolios to aggressive growth strategies, regardless of individual policyholder risk profiles, to quickly boost returns. Explanation. This scenario presents a professional challenge because it requires an FLMI-designated professional to balance the fiduciary duty to clients with the practical realities of investment performance and regulatory compliance. The core tension lies in managing client expectations regarding investment returns while adhering to the strict disclosure and suitability requirements mandated by U.S. insurance and securities regulations. The professional must exercise sound judgment to ensure that investment recommendations are not only aligned with client objectives, but also presented with appropriate transparency regarding associated risks and potential returns, avoiding any misrepresentation or omission of material facts. The correct approach involves a comprehensive review of the investment portfolio's performance in the context of its stated objectives and risk profile, followed by clear, documented communication with clients. This communication should detail the factors influencing performance, both positive and negative, and reevaluate the suitability of the current investment strategy in light of the efficiency study's findings and prevailing market conditions. This aligns with regulatory requirements that emphasize suitability, disclosure, and the fiduciary duty to act in the client's best interest. Specifically, regulations like those under the Securities and Exchange Commission, SEC, and state insurance departments require that investment recommendations be suitable for the client, that all material risks and potential returns be disclosed, and that ongoing monitoring and adjustments be made as necessary. An incorrect approach would be to solely focus on the underperformance without considering the underlying reasons or the client's risk tolerance. This could lead to hasty, unsuitable changes to the portfolio that might expose the client to new, unmanaged risks or fail to meet their long-term financial goals. Another incorrect approach would be to downplay or omit the implications of the efficiency study's findings in client communications. This constitutes a failure of disclosure and could be construed as misleading, violating regulations that mandate transparency about investment performance and associated risks. Furthermore, making investment decisions based solely on short-term market fluctuations, without regard for the client's long-term objectives and risk profile, is a violation of the suitability standard. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the findings of the efficiency study and their implications for the investment strategy. Second, assess the current portfolio's alignment with client objectives, risk tolerance, and time horizon. Third, engage in transparent and documented communication with clients, explaining the study's findings, the portfolio's performance, and any proposed adjustments. Fourth, ensure all recommendations and actions strictly adhere to all applicable U.S. federal and state regulations governing investment advice and insurance products, prioritizing client best interests above all else. Question 13. The monitoring system demonstrates a significant increase in policy lapse rates within a low-income demographic, coinciding with a period of rising inflation and reduced government assistance programs. Which of the following approaches best addresses this implementation challenge, while adhering to the principles of responsible insurance provision and regulatory compliance? Option A. Implement a modest increase in premium rates across all policy types to absorb the financial impact of the higher lapse rates. Option B. Conduct a comprehensive review of policyholder communication channels and premium payment flexibility options, alongside an analysis of the socio-economic factors influencing affordability, to develop targeted support programs and educational initiatives. Option C. Immediately launch an aggressive marketing campaign to acquire new policyholders to offset the revenue loss from the increased lapses. Option D. Reduce the benefit payouts on existing policies within this demographic to lower the overall cost of coverage. The correct answer is B. Conduct a comprehensive review of policyholder communication channels and premium payment flexibility options, alongside an analysis of the socio-economic factors influencing affordability, to develop targeted support programs and educational initiatives. Explanation. The monitoring system demonstrates a significant increase in policy lapse rates within a low-income demographic, directly impacting the social and economic stability of these policyholders. This scenario is professionally challenging because it requires balancing the company's financial health with its societal obligations, particularly when dealing with vulnerable populations. The FLMI designation emphasizes ethical conduct and understanding the broader impact of insurance products. Careful judgment is required to identify the root causes and implement appropriate compliance solutions. Correct approach involves a multifaceted investigation into the underlying socio-economic factors contributing to the lapse rates. This includes analyzing affordability issues, understanding the effectiveness of communication strategies regarding policy benefits and renewal processes, and assessing the accessibility of customer support for this demographic. This approach is right because it aligns with the ethical imperative to serve policyholders fairly and responsibly, as underscored by industry best practices and the spirit of insurance as a social safety net. Regulatory frameworks often encourage or mandate fair treatment of customers, and proactive measures to prevent undue hardship for policyholders are considered sound business and ethical practice. An incorrect approach that focuses solely on increasing marketing efforts to replace lapsed policies fails to address the core problem. This is ethically problematic, as it prioritizes new sales over retaining existing coverage for those who may be struggling, potentially exacerbating their financial insecurity. It also ignores the potential for regulatory scrutiny regarding customer retention and fair practices. Another incorrect approach that involves simply raising premium prices to offset potential losses is also professionally unacceptable. This would disproportionately burden the low-income demographic, making coverage even less affordable and likely leading to further lapses, creating a negative feedback loop. This approach demonstrates a lack of social responsibility and could be viewed as predatory, potentially violating consumer protection regulations. A third incorrect approach that involves reducing policy benefits to lower costs would undermine the fundamental purpose of insurance for this demographic, leaving them with inadequate protection. This is ethically unsound and could lead to significant reputational damage and regulatory intervention, as it fails to deliver on the promise of security that insurance is intended to provide. The professional decision-making process for similar situations should involve a systematic approach. First, clearly identify the problem and its potential impact on policyholders and the company. Second, gather data to understand the root causes, considering both internal operational factors and external socio-economic influences. Third, brainstorm potential solutions, evaluating each against ethical principles, regulatory compliance, and long-term sustainability. Fourth, implement the chosen solution with clear communication and ongoing monitoring. Finally, be prepared to adapt the strategy based on feedback and evolving circumstances. Question 14. Research into a life insurance policy application submitted 2 years and 3 months ago reveals a material misrepresentation regarding the applicant's smoking status. The policy is currently in force, and the insured has recently passed away. The underwriting department has flagged this misrepresentation as a potential basis for claim denial. What is the most appropriate course of action for the claims department to take, considering standard life insurance policy provisions and regulatory frameworks governing contestability? Option A. Pay the full death benefit as the policy is now incontestable due to the passage of time beyond the typical contestability period. Option B. Deny the claim outright based on the material misrepresentation discovered in the application. Option C. Initiate a lengthy investigation into the applicant's lifestyle to gather further evidence of misrepresentation. Option D. Offer a reduced death benefit equivalent to the premiums paid, as the misrepresentation voids the policy. The correct answer is A. Pay the full death benefit as the policy is now incontestable due to the passage of time beyond the typical contestability period. Explanation. This scenario presents a professional challenge because it requires an insurance professional to interpret and apply specific policy provisions in a way that aligns with both contractual obligations and regulatory requirements, while also considering the ethical implications of their actions. The challenge lies in balancing the insurer's contractual rights with the policyholder's reasonable expectations and ensuring fair treatment. Careful judgment is required to avoid misinterpreting the policy language, which could lead to improper claim denial or benefit reduction, potentially resulting in regulatory scrutiny and damage to the company's reputation. The correct approach involves a thorough review of the policy's contestability clause and the specific facts presented by the applicant. This approach is right because the contestability clause, as typically defined in life insurance policies and regulated by state insurance laws, sets a time limit, usually 2 years, during which the insurer can contest a policy based on material misrepresentations in the application. After this period, the policy generally becomes incontestable, except for specific exclusions like non-payment of premiums or fraudulent misstatements. Adhering to this provision ensures that the policyholder's coverage is secure after the contestable period, upholding the principle of good faith and fair dealing inherent in insurance contracts and mandated by regulations. An incorrect approach would be to deny the claim solely based on the discovered misrepresentation without considering the contestability period. This fails to acknowledge the contractual limitation on the insurer's right to contest, which is a fundamental policy provision. Ethically and regulatorily, this approach could be seen as a breach of contract and potentially an unfair claims settlement practice, as it disregards a key protection afforded to the policyholder. Another incorrect approach would be to offer a significantly reduced death benefit without a clear contractual basis or regulatory justification. Some policies might allow for adjustments under specific circumstances. Doing so arbitrarily or without proper policy language to support it would violate the terms of the contract and could be considered an unfair practice. This disregards the policyholder's right to the coverage they purchased and paid premiums for. A further incorrect approach would be to delay the claim investigation indefinitely without communicating with the beneficiary. This violates regulations that mandate prompt investigation and communication regarding claims. Such a delay can cause undue hardship to the beneficiary and is considered an unfair claims practice. The professional decision-making process for similar situations should involve 1. Identifying the relevant policy provisions, particularly those related to contestability, exclusions, and claims procedures. 2. Ascertaining the specific facts of the case and comparing them against the policy terms and applicable regulations. 3. Consulting with legal counsel or senior claims personnel if there is ambiguity in the policy language or regulatory interpretation. 4. Communicating clearly and promptly with all parties involved, including the policyholder or beneficiary, regarding the status of the claim and any required actions. 5. Making a decision that is consistent with the policy contract, regulatory requirements, and ethical principles of fairness and good faith. Question 15. To address the challenge of recommending an appropriate life insurance product to a client seeking long-term financial security and a death benefit, which of the following approaches best demonstrates adherence to regulatory requirements and ethical best practices for an FLMI professional? Option A. Focusing the discussion on the policy's cash value growth potential, while omitting details about the associated fees and surrender charges. Option B. Suggesting a policy with a complex structure and significant riders, without fully explaining the implications of each component to the client. Option C. Recommending a single policy that offers the highest commission to the agent, emphasizing its perceived benefits while minimizing discussion of its drawbacks. Option D. Presenting a range of suitable policy options, detailing their respective features, benefits, limitations, and costs, and allowing the client to make an informed decision after thorough discussion. The correct answer is D. Presenting a range of suitable policy options, detailing their respective features, benefits, limitations, and costs, and allowing the client to make an informed decision after thorough discussion. Explanation. This scenario presents a professional challenge because it requires an FLMI-designated professional to balance client needs with regulatory obligations and ethical considerations in insurance planning. The core difficulty lies in identifying the most suitable insurance product that aligns with the client's stated goals while adhering to disclosure requirements and avoiding misrepresentation. Careful judgment is essential to ensure the client receives appropriate advice and the professional maintains integrity. The correct approach involves a thorough needs analysis, followed by a clear explanation of suitable product options, including their benefits, limitations, and costs without undue pressure. This aligns with best practices in client advisory roles, emphasizing transparency and suitability. Specifically, regulatory frameworks governing insurance sales, such as those enforced by state insurance departments in the U.S., mandate that agents and advisors recommend products that are suitable for the client's financial situation, needs, and objectives. This includes providing accurate and complete information about policy features, premiums, and potential risks. Ethical guidelines also underscore the importance of acting in the client's best interest, which necessitates a comprehensive understanding of their circumstances before recommending any product. An incorrect approach that focuses solely on a high-commission product, regardless of its suitability, violates regulatory requirements for suitability and ethical principles of client best interest. This can lead to misrepresentation and potential harm to the client, resulting in regulatory sanctions and damage to professional reputation. Another incorrect approach that involves downplaying the limitations or risks of a particular policy or failing to disclose all relevant information constitutes misrepresentation and a breach of fiduciary duty. This directly contravenes regulations that require full and fair disclosure. Finally, an approach that prioritizes closing the sale quickly over ensuring the client fully understands the product and its implications fails to meet the standard of care expected of a financial professional and can lead to client dissatisfaction and regulatory scrutiny. Professionals should employ a decision-making framework that begins with a comprehensive client discovery process to understand their financial situation, goals, and risk tolerance. This is followed by an objective evaluation of available product options, considering their suitability against the client's profile. Transparency in explaining product features, benefits, drawbacks, and costs is paramount. The final recommendation should be clearly documented and based on the client's informed consent, ensuring compliance with all applicable regulations and ethical standards. Question 16. Analysis of how an insurance professional should educate a client about individual retirement arrangements, IRA, involves understanding the permissible scope of information. Considering U.S. federal regulations, which of the following approaches best aligns with regulatory requirements and ethical professional conduct when a client inquires about opening an IRA? Option A. Stating that all contributions to any IRA are tax-deductible, regardless of income level or IRA type. Option B. Recommending the client open a Roth IRA, explaining that it is generally superior for younger individuals due to anticipated future tax rate increases. Option C. Focusing exclusively on the various investment products available for purchase within an IRA, such as mutual funds and annuities, without detailing the IRA structure itself. Option D. Providing a detailed comparison of traditional and Roth IRA tax treatment, contribution limits, and withdrawal rules, while emphasizing that specific investment choices within an IRA should be discussed with a qualified financial advisor. The correct answer is D. Providing a detailed comparison of traditional and Roth IRA tax treatment, contribution limits, and withdrawal rules, while emphasizing that specific investment choices within an IRA should be discussed with a qualified financial advisor. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complexities of individual retirement arrangements in the context of client education and product suitability, while adhering strictly to U.S. federal regulations governing IRAs. The challenge lies in providing accurate and compliant information that empowers the client to make informed decisions without offering specific investment advice that could be construed as a fiduciary duty or misrepresentation. The professional must balance the need to explain IRA options with the limitations imposed by their role and regulatory requirements. The correct approach involves clearly differentiating between the types of IRAs, traditional and Roth, and their general tax implications, as well as outlining the contribution limits and withdrawal rules as defined by the IRS. This approach is correct because it focuses on providing factual, educational information about the IRA structures themselves, which is permissible and expected. It avoids recommending specific investments or strategies, thereby staying within the bounds of regulatory compliance and ethical practice. The justification is rooted in IRS publication 590 and 590B, which detail IRA rules. Professionals are permitted to educate clients on the features of different retirement savings vehicles. An incorrect approach would be to recommend a specific IRA type, e.g., you should open a Roth IRA because your income is likely to increase, without a thorough understanding of the client's complete financial picture and without being licensed or authorized to provide such advice. This is a regulatory failure because it crosses the line from education to personalized financial advice, potentially violating securities regulations if the professional is not properly registered. It also creates an ethical issue by potentially leading the client to a suboptimal decision based on incomplete information or the professional's own biases. Another incorrect approach would be to provide overly simplistic or misleading information about tax benefits, such as stating that all IRA contributions are tax-deductible, without clarifying the income limitations for traditional IRAs. This is a factual misrepresentation and a regulatory failure, as it can lead to incorrect assumptions and planning by the client. It violates the principle of providing accurate and complete information. A third incorrect approach would be to focus solely on the investment products that can be held within an IRA, without adequately explaining the IRA structure itself. This is a failure to educate the client on the fundamental nature of the retirement account, which is the primary subject of the inquiry. It prioritizes product sales over client understanding of the retirement savings vehicle. The professional decision-making process for similar situations should involve a clear understanding of the scope of their role in licensing. Professionals should always prioritize client education on the mechanics and rules of retirement accounts, referencing official IRS guidance. They must be acutely aware of the distinction between providing general information and offering specific investment recommendations or advice. When in doubt, it is always best to err on the side of caution. Refer the client to a qualified financial advisor or tax professional for personalized advice, and document all client interactions and the information provided. Question 17. The investigation demonstrates that a life insurance company's marketing department has been actively promoting a new product line by implying it offers comprehensive health coverage that meets Affordable Care Act, ACA, minimum essential coverage standards, even though the product is primarily a supplemental health policy with limited benefits and is not sold through ACA-compliant marketplaces. The sales team is being incentivized to emphasize the health coverage aspects to drive sales. What is the most appropriate immediate course of action for the company's compliance officer? Option A. Instruct the marketing department to slightly rephrase the promotional materials to be less direct about ACA compliance while continuing sales efforts, pending a later, less urgent review. Option B. Immediately halt all marketing and sales activities related to the product that imply ACA compliance and initiate a comprehensive review of all marketing materials and sales scripts for accuracy and adherence to ACA regulations and state insurance laws. Option C. Advise the sales team to focus on the supplemental nature of the policy and downplay any references to health coverage to avoid confusion, without a formal review of existing materials. Option D. Continue the current marketing and sales strategy, assuming that the supplemental nature of the policy will eventually become clear to consumers and that regulatory scrutiny is unlikely given the product's primary classification. Correct answer is B. Immediately halt all marketing and sales activities related to the product that imply ACA compliance and initiate a comprehensive review of all marketing materials and sales scripts for accuracy and adherence to ACA regulations and state insurance laws. Explanation: this scenario presents a professional challenge because it requires balancing the company's financial interests with the ethical obligation to provide accurate and compliant information to consumers, particularly concerning a complex and impactful piece of legislation like the Affordable Care Act, ACA. The dilemma lies in the potential for misrepresenting the availability of ACA-compliant plans to boost sales, which could lead to significant consumer harm and regulatory penalties. Careful judgment is required to ensure that all marketing and sales practices are truthful and adhere to the specific requirements of the ACA and related state insurance regulations. The correct approach involves immediately ceasing the misleading marketing campaign and initiating a thorough review of all sales materials and practices to ensure full compliance with the ACA. This approach prioritizes consumer protection and regulatory adherence. Specifically, the ACA mandates that health insurance plans offered must meet certain minimum essential coverage standards and be offered through compliant marketplaces or as grandfathered plans. Misrepresenting the availability of such plans violates the spirit and letter of the ACA, which aims to expand access to affordable, comprehensive health insurance. Ethically, it is paramount to act with integrity and transparency, avoiding deceptive practices that could lead individuals to purchase inadequate coverage or incur unexpected costs. An incorrect approach would be to continue the marketing campaign while subtly altering the language to be less overtly misleading, without a comprehensive review. This fails to address the root cause of the problem and still risks consumer confusion and potential violations. It demonstrates a lack of commitment to full compliance and ethical conduct. Another incorrect approach would be to dismiss the concerns as minor marketing oversights and only make superficial changes to the materials. This ignores the potential for significant harm to consumers who rely on accurate information to make critical healthcare decisions. It also disregards the serious regulatory consequences of noncompliance, which can include substantial fines and reputational damage. A further incorrect approach would be to prioritize sales targets over compliance by continuing the campaign as is, hoping that the issue will not be detected. This is a clear ethical breach and a direct violation of regulatory requirements. It prioritizes short-term financial gain over consumer welfare and legal obligations, exposing the company to severe penalties. Professionals should approach such situations by first recognizing the potential for harm and regulatory violation. The decision-making process should involve 1. Immediate cessation of any potentially non-compliant activity. 2. Escalation of the issue to relevant compliance and legal departments. 3. A thorough, independent review of all affected practices and materials against applicable regulations, in this case, the ACA and relevant state insurance laws. 4. Implementation of corrective actions to ensure future compliance. 5. Documentation of the process and corrective measures taken. This systematic approach ensures that ethical obligations and regulatory requirements are met, protecting both consumers and the organization. Question 18. During the evaluation of a complex life insurance policy claim where a significant payout is anticipated, a senior claims analyst discovers that a close personal friend of their direct supervisor is the beneficiary. The analyst also notes that the policy's terms and conditions, while clear, could be interpreted in a way that slightly reduces the payout if a specific, less common clause is applied. The supervisor has subtly indicated a preference for a more conservative interpretation of the policy terms. Which of the following approaches best upholds ethical principles and regulatory compliance in this situation? Option A. Process the claim based on the most favorable interpretation for the policyholder without mentioning the supervisor's preference or the potential conflict of interest, assuming the supervisor's preference was merely a casual remark. Option B. Immediately escalate the situation to the compliance department and legal counsel, disclosing the potential conflict of interest and the existence of an alternative interpretation, and request guidance on how to proceed to ensure impartiality. Option C. Inform the supervisor of the potential conflict and the alternative interpretation, and then proceed with the interpretation that the supervisor suggests, believing that transparency with the supervisor is sufficient. Option D. Proceed with the more conservative interpretation of the policy terms, as it aligns with the supervisor's preference and the company's general interest in managing payouts, and do not mention the personal relationship or the alternative interpretation to anyone. The correct answer is B. Immediately escalate the situation to the compliance department and legal counsel, disclosing the potential conflict of interest and the existence of an alternative interpretation, and request guidance on how to proceed to ensure impartiality. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with the ethical obligation to act in the best interest of the policyholder and maintain public trust. The FLMI designation emphasizes ethical conduct and adherence to regulatory standards, which are paramount in insurance operations. Careful judgment is required to navigate potential conflicts of interest and ensure that decisions are not only legal but also morally sound. The correct approach involves proactively identifying and disclosing the potential conflict of interest to all relevant parties, including the policyholder and management, and seeking an independent review or guidance. This demonstrates transparency, upholds the principle of acting in the policyholder's best interest, and aligns with the ethical duty to avoid even the appearance of impropriety. Regulatory frameworks, such as those governing fiduciary duties and fair dealing, mandate such transparency and diligence. Ethically, it reinforces the commitment to integrity and client welfare, which are foundational to the insurance profession. An incorrect approach that involves proceeding with the recommendation without disclosure fails to uphold the duty of loyalty and good faith owed to the policyholder. This action creates a significant conflict of interest and could be construed as self-dealing or a breach of fiduciary responsibility, violating regulatory prohibitions against unfair or deceptive practices. Another incorrect approach, which is to dismiss the potential conflict and proceed as if it does not exist, demonstrates a lack of due diligence and ethical awareness. This can lead to decisions that are not truly in the policyholder's best interest, potentially causing financial harm and eroding trust. It ignores the ethical imperative to be vigilant about potential conflicts and to act with integrity. Finally, an incorrect approach that involves seeking to minimize the policyholder's benefit to align with the company's preferred outcome, without a clear, objective, and documented basis for such a reduction, is unethical and likely violates regulations concerning fair claims handling and policy administration. This prioritizes the company's financial gain over the policyholder's contractual rights. Professionals should employ a decision-making framework that prioritizes ethical considerations. This involves identifying potential conflicts of interest, assessing their impact on stakeholders, consulting relevant ethical codes and regulations, seeking advice when necessary, and choosing the course of action that best upholds integrity, fairness, and the policyholder's interests, even if it is not the most financially advantageous in the short term. Question 19. System analysis indicates that a new comprehensive data privacy regulation has been enacted, requiring more explicit and granular customer consent for the collection and use of personal information in life insurance products. The company's current consent forms and data usage policies were established under previous, less stringent regulations. Which of the following approaches best addresses this regulatory shift? Option A. Rely on the existing consent forms, assuming they implicitly cover the new regulatory requirements due to their general nature. Option B. Conduct a thorough review of existing customer consent forms and data handling policies, updating them to explicitly meet the new regulations requirements for informed and granular consent, and subsequently train all relevant staff on the revised procedures. Option C. Delay the implementation of any changes until the regulatory body provides specific guidance on how existing consent mechanisms should be interpreted under the new law. Option D. Implement the new regulations requirements only for new policy applications, while continuing to use existing consent mechanisms for all current policyholders. The correct answer is B. Conduct a thorough review of existing customer consent forms and data handling policies, updating them to explicitly meet the new regulations' requirements for informed and granular consent, and subsequently train all relevant staff on the revised procedures. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how evolving regulatory requirements impact established business practices within the life insurance industry, specifically concerning data privacy and customer consent. The challenge lies in balancing the need for operational efficiency with the imperative to comply with stringent data protection laws, ensuring that customer data is handled ethically and legally. Careful judgment is required to interpret the scope of new regulations and their practical implications for existing consent mechanisms. The correct approach involves proactively reviewing and updating customer consent forms and data handling policies to align with the new regulatory framework. This demonstrates a commitment to compliance and customer trust. Specifically, this approach is right because it directly addresses the core of the regulatory change by ensuring that customer consent is obtained and managed in a manner that is explicit, informed, and granular, as typically mandated by modern data privacy laws like GDPR or similar state-level regulations in the U.S. This proactive stance minimizes the risk of noncompliance, potential fines, and reputational damage, while reinforcing the company's ethical responsibility to protect customer data. An incorrect approach would be to assume that existing consent forms are sufficient without a thorough review. This fails to acknowledge that regulatory frameworks evolve and often introduce new requirements for clarity, specificity, and the right to withdraw consent. This approach risks continued noncompliance with the new regulations, leading to potential enforcement actions and penalties. Another incorrect approach would be to implement the changes without adequately training staff on the new consent procedures and data handling protocols. This creates a significant risk of inconsistent application of the new rules, leading to inadvertent breaches of privacy and consent violations. It also undermines the effectiveness of the updated policies by not ensuring that the operational staff understand and can execute them correctly. Finally, an incorrect approach would be to prioritize business continuity and operational efficiency over immediate regulatory compliance by delaying the implementation of necessary changes. While operational stability is important, it cannot supersede legal and ethical obligations. This delay exposes the company to significant legal and financial risks, as well as a loss of customer confidence, which can have long-term detrimental effects on the business. Professionals should adopt a systematic approach to regulatory change management. This involves establishing a dedicated compliance team or assigning clear responsibilities for monitoring regulatory updates. Upon identification of new requirements, a thorough impact assessment should be conducted, followed by the development and implementation of revised policies and procedures. Crucially, comprehensive staff training and ongoing monitoring are essential to ensure sustained compliance and ethical data handling practices. Question 20. The assessment process reveals that a client nearing retirement has expressed a desire to maintain their current lifestyle and has provided a specific savings amount they believe will be sufficient. However, the advisor notes that the client has not explicitly considered the impact of inflation on their future purchasing power or the potential for significant healthcare costs in later life. Which approach best addresses the client's retirement needs analysis in this context? Option A. Proceeding with the client's stated savings plan, assuming their calculations are accurate and their lifestyle needs will remain constant. Option B. Conducting a comprehensive risk assessment that incorporates inflation projections, potential healthcare expenditures, and market volatility to determine a more robust retirement income strategy. Option C. Focusing solely on maximizing investment returns in the short term to meet the client's immediate savings goals. Option D. Recommending a reduction in the client's desired retirement lifestyle to align with their current savings trajectory. The correct answer is A. Proceeding with the client's stated savings plan, assuming their calculations are accurate and their lifestyle needs will remain constant. Explanation. This scenario presents a professional challenge because it requires balancing the client's stated preferences with a comprehensive understanding of their potential future needs, particularly in the context of retirement. The FLMI designation implies a commitment to ethical conduct and client-centric advice, which necessitates going beyond surface-level information. A robust retirement needs analysis must consider various risk factors that could impact the client's financial security in retirement, not just their current stated desires. The correct approach involves a thorough risk assessment that identifies and quantifies potential threats to the client's retirement plan. This includes evaluating factors such as inflation, longevity risk, healthcare costs, market volatility, and potential changes in tax laws. By proactively addressing these risks, the advisor can help the client develop a more resilient and sustainable retirement strategy. This aligns with the ethical duty of care and the regulatory expectation to provide advice that is in the client's best interest, ensuring they are adequately prepared for the uncertainties of retirement. An incorrect approach would be to solely rely on the client's current savings rate and stated income needs without considering the impact of inflation. This fails to acknowledge the erosion of purchasing power over time, potentially leaving the client with insufficient funds to maintain their desired lifestyle. Ethically, this is a failure to provide comprehensive advice. Another incorrect approach is to ignore the potential for unexpected healthcare expenses. These costs can be a significant drain on retirement assets, and failing to account for them can lead to a severe shortfall. This represents a regulatory failure to conduct a complete needs analysis and an ethical lapse in not safeguarding the client's financial well-being. A third incorrect approach is to assume a consistently high rate of return on investments without considering market volatility. This can lead to an overestimation of future wealth accumulation and a false sense of security. This is a failure to adhere to prudent investment principles and a potential violation of regulatory guidelines regarding realistic financial projections. The professional decision-making process for similar situations should involve a systematic approach to client assessment. This begins with active listening to understand the client's stated goals and concerns. However, it must then proceed to a deeper analysis of potential risks and variables that could affect those goals. Utilizing tools and methodologies that incorporate risk factors, such as scenario planning and sensitivity analysis, is crucial. The advisor must then clearly communicate these risks and the rationale behind their recommendations to the client, empowering them to make informed decisions. This process ensures that advice is not only responsive to immediate requests, but also robust enough to withstand future uncertainty, fulfilling both ethical and regulatory obligations.